Thank you for joining us for our continued programming as part of the FSEA online learning experience. My name is Jeff Peterson, the Executive Director of FSEA. Our next presentation is entitled the R&D Tax Credit, and our speaker today is Michael Devereux with Mueller Prost. Michael is a partner and director of manufacturing, distribution, and plastics industry services for Mueller Prost. His primary focus is on tax incentives for the manufacturing sector. Mueller Prost Tax Incentive Group is nationally recognized and has assisted hundreds of manufacturers in capturing these benefits. FSEA has recently established a partnership with Michael and Mueller Prost to market and educate our FSEA members on the potential benefits of R&D tax credits. So let me introduce you now to Michael Devereux.
Thank you very much, Jeff. I'm happy to be with you today. Really looking forward to talking about the research credit and how that tax credit can help your membership.
Okay, so let's get started with some questions for Michael. Michael, what is the R&D tax credit, and how can FSEA members take advantage of the tax credit?
Thanks, Jeff. The credit it's a federal tax credit that essentially rewards innovation. It rewards the development of new processes, new techniques, new formula development, if that's appropriate, and new inventions. And so it's a federal credit. It's been around since 1981. Now, this credit's expired numerous times, but in 2015, they made the credit permanent, part of the tax code. And so since then, we've seen an uptick in the number and breadth of different companies that were claiming this credit. And, in addition to the federal credit, there's 35 states that have a research credit program as well. And that's in addition to the federal credit. It's based upon the federal definition of research. And those states then reward that depending upon where the research is being performed. So if I have operations in both Indiana and Missouri, I'm only going to get to include that research time and research expenditures that are incurred in Indiana for the Indiana credit. Now, Missouri does not, for example. But there are 35 states that have a research credit program as well. In 2014, 12.5 billion federal research credits were claimed. And almost 60% of that was claimed by manufacturers. And if you drill down into the data a little bit further, we had to go back to the prior year because that's the last year they had this information available for the manufacturing sector. But in 2013, printing and related support activities, that's the broad-based NAICS code that finishers fall under, claimed almost $10 million in federal research credits. And so the credit it's substantial. It can be really impactful to the operations of a finisher.
Okay, and what activities are FSEA members performing that could qualify for the R&D tax credit?
Well, there's two concepts at play here. There's the definition of a qualified research activity, and that's the whole premise of the credit. It's based upon qualified research activities. And the other concept is the type of expenditures that will qualify, and we'll get to that here in a minute. Because let's talk about the definition of a qualified research activity. There are 4 requirements to a qualified activity. The first is that I have to be developing or improving a business component. Now, business components are defined as products, processes, techniques, formulas, inventions, or software applications. These different business components, I could be developing a new business component, or I could be improving an existing business component. And I came up with a list of some things that I've seen within FSEA members' shops that I think would be qualified here. And so if I'm developing a piece-specific production process, in other words, a customer comes in to me and say, here are the specifications that I'd like from a finishing operation, and I then have to develop a process that's specific to that piece. Well, if I'm engaging in all the other requirements of a qualified activity, that production process can qualify for the credit, or the development of that production process, I should say, would qualify for the credit. In addition, if you're developing new or improved techniques, that could certainly meet the definition of a qualified research activity because I'm developing that business component. And then this third one I think is important. Internally developed equipment. Sometimes you may get an order in or from a customer that your existing equipment doesn't have the capability in order to produce that, or at least maybe doesn't have the capability to produce that at the speed you want it to. So you then maybe invest in developing your own equipment. You can't find it commercially, and so maybe you're combining a couple of different technologies. Well, internally developed equipment can certainly qualify and meet that definition of a business component. Now, the second requirement is that it be technological in nature. So I don't get to count non-technological things like cosmetic or aesthetic type things. Now you might be saying, Mike, wait a minute here. We're finishers. We live in the aesthetic world. We make things look good. Well, that's certainly true, and aesthetic and cosmetic is certainly a piece of what you're developing and doing. However, it's not the end result where the research is taking place. You've got an idea of how something should look, how something should perhaps feel, if it's an embellishment or embossing process that you're doing, but you've got to have some technological development in order to achieve that. And that's where the activities that we're talking about. So you might have a conceptual design from a cosmetic perspective that doesn't qualify. Now I've got to put my engineering hat on, my physical sciences hat on. Maybe I've got to rely upon the chemical sciences in order to determine, how is this going to adhere to this particular piece, adhesion techniques and so forth, whether that be heat transferred or whatever the case might be. There's a chemical process that occurs there, and therefore it fundamentally relies upon the sciences. And so the activities that we're talking about are technological in nature. They do rely upon the engineering disciplines. We do rely upon the chemical sciences every day, because you're not required to expand, exceed, or even refine the knowledge in your industry. That requirement went away in 2001. Before 2001, that was the standard. You had to be doing something nobody else was doing. You had to be a pioneer, and you had to prove that you were a pioneer to the IRS. Well, that requirement went away years ago, and now the standard is, am I fundamentally relying upon the sciences here? Is it technological in nature? And if the answer is yes, I meet this second requirement. Now that brings up the third requirement. There has to be uncertainty that exists at the beginning of my research activities. So the information that you have to be trying to obtain has to be aimed at eliminating that uncertainty. Now, uncertainty exists if the capability of developing or improving that business component is uncertain, the method of doing so is uncertain, or if the appropriate design is uncertain. Now, folks, capability is what most people think of when they think of R&D. Is this possible? Can I do this? Can I even meet this specification in the time frame that I would need to make it perform in a profitable manner? Is this possible to be done? Well, capability uncertainty certainly does set an awfully high bar, but that's not the only requirement. And like I said, most people think of capability uncertainty when they think of R&D, but method and design uncertainty is frankly where we see most of the design uncertainty, or most of the uncertainties associated with our clients' qualified research. And so, do I have a methodology in place for developing this production process? Do I have a method in place for developing this part specific, or this piece specific, process? But almost always it's the design alternatives. Because if I go to 10 different finishers and say, here are my specifications that I need for this particular piece, you're all not going to use the same process. There's different design alternatives related to that process or that technique that you may use in order to achieve the specifications that I called out. Well, that design uncertainty, if you're eliminating that uncertainty through experimentation, it's qualified research. And design alternatives just means more than one alternative, that design uncertainty. And so if I'm evaluating those different alternatives through a process of experimentation, which is my fourth requirement, then I've got a qualified research activity. Process of experimentation, they define as modeling, simulation, or systematic trial and error. Well, modeling could be creating samples, right? I'm creating models to show off my capabilities, to show off how I can develop different techniques, or how I can design a process to meet a particular customer's need, right? And so that those modeling activities or simulation activities can all qualify for this credit. Now, this iterative experimentation many times could happen at the beginning of a job, where you might have a couple of different alternatives that you're considering, and you run it and you make modifications. You run it and make modifications. It's certainly going to be present if you're developing any equipment in-house or combining different technologies. You may run it, make tweaks, run it, make modifications, run it again. Oh, wait, this works, but maybe we can make a modification. Oh, the customer doesn't like this. Now we got to go back and make modifications again. This iterative experimentation is where all this qualified time and qualified research activities can go. So at a high level, that's the definition of a qualified research activity. Am I developing or improving a product, process, or technique? Is it technological in nature? Am I eliminating design uncertainty? And am I eliminating that design uncertainty through experimentation, as I've shown here? Now, when we talk about research, it has to be aimed at either developing or improving functionality, performance, reliability, or quality. Folks, those are 4 pretty broad terms. And if you're trying to develop or improve to those standards, you've got a qualified research activity.
Great, thanks, Michael. Next question. Can you give us some examples of activities that could qualify for the credit?
Sure. In anticipation of this presentation, I came up with a list of different activities that I've seen in various FSEA members' plants and operations. And here are some examples. So if I'm experimenting with different digital enhancements or different foil decorating techniques for a specific finishing job. Now, I want to call this out, this first kind of bullet point out here, in the sense that notice it says with a specific finishing job. I don't have to be developing a new technology or a new product that I'm just going to hang on my shelf, so to speak, and go out and try and sell my wares. All my research can be specific to a particular customer. It can be specific to a particular job. It can be a particular process within a job. And so we shrink down to those different activities that really kind of meet the definition. And so that first one kind of goes to the heart of that in developing a different technique for a specific job. Maybe you're experimenting with different metallic foil decorating techniques or processes. If you're experimenting with different hot foil stamping or cold foil transfer, I'm sure each of you have either used or tried some of these different methodologies, but does it work for that particular application? Is the design appropriate for that particular customer, their need, right? And so experimenting with different foil transfer with either toner-based adhesives or polymer-based adhesives. If you're doing anything with spot-raised UV coatings or shelf life, if I've got a particular finish that I'm putting on a piece, what happens to it after 6 months? Are you trying to simulate that, or is there going to be change? What if I leave this out in the sun? Is it going to get modified, or is it going to have physical damage to it because of the heat? There's all kinds of different experiments that you all might be running with respect to either the coating piece itself or the impact that different finishes could have on the piece itself in different environments. You could be experimenting with different stripping techniques. If you don't have the stripping down right, as you guys all know, you could have downtime with your process. And if you're making modifications or experimenting different ways to reduce that can qualify. Different fixturing or stripping tools or different dyes that are specific, the design and development of those can certainly qualify for this credit. Different embellishing techniques, creating samples. Samples are essentially prototypes, folks. That essentially can help you showcase your capabilities, but they're prototypes. That is something where you're developing a prototype and then kind of adding it to your portfolio, so to speak, of things that you can do to solve your customers' problems. Research new forms on post-press decorating. Experimenting with new production equipment development. As I mentioned earlier, if you're developing specific pieces of equipment in particular in conjunction with the development or improvement to a production process, that can be a qualified activity. And it's not just the engineering piece that happens up front, right? So the engineering piece might happen up front. I come up with a conceptual design. I create that pilot model. I then maybe create some experiments around that pilot model and test it. I refine it. I maybe make modifications to it. Well, that's all experimentation and can qualify for this tax credit. And so it can be quite significant there, activity if you're doing those sort of things.
You know, Michael, something I might point out that you were just talking about that I think a lot of our members and those on our conference, that samples or, prototypes or producing, samples of their work that they can do, if it's with foil, embossing, digital decorating, that the tooling and the foils and paper and time and so forth, you're saying creating those samples, prototypes could qualify for these tax credits.
Yes, sir. Absolutely. And the premise is the design is uncertain right at the outset. And while you may have a conceptual design up front, and I've developed that isn't proven out until I've went through the production process. That's the challenging part, as you all know, is producing that to the design or the conceptual design that's been met. Well, that design uncertainty really isn't eliminated until I've proven out that design, and therefore the expenditures that feed into that throughout the process can all qualify for the tax credit.
Great, thanks. Next question. What expenditures qualify for the credit? Do all research expenditures count?
Okay, so that's the other concept at play here. We talked about the definition of a qualified research activity. We talked about some examples that are specific to FSEA members with respect to qualified activities. Now let's shift gears over to the expenditure side of the house. And that's with respect to what types of expenditures meet the definition of qualified research for purposes of the credit, because there's two different code sections at play here. This is code section 41B. And Jeff, I apologize for getting geeky here and quoting code sections here during my presentation, but it's an important differentiation, because research expenditures, the ability to deduct and reduce your taxable income by the expenditures related to research and experimentation, that's code section 174. And that definition is a little bit broader. For instance, if I go out and I patent a process, well, my patent attorney fees are research expenditures, and therefore I can deduct those as they're paid or incurred. I don't have to capitalize them, and I reduce my taxable income. They are research expenditures. Patent attorney fees is right in the Treasury regulations. However, patent attorney fees don't qualify for the tax credit. Only 3 types of expenditures meet that definition, and not all of those expenditures meet that definition. Let me give you an example. The first bullet point up here is qualified wages for employees. Well, qualified wages for employees is essentially the pro rata portion of box 1 of Form W-2 that an employee spends on what's called qualified services or qualified research activities. I don't get to count benefits. I don't get to account for overhead that's attributable to that employee's wage. I don't get to count those things. Those are 174 research expenditures, but they don't qualify for the credit. So let's focus on the things that do qualify for the credit. Like I said, box 1 of Form W-2 is kind of the starting point of my qualified wage. And so I get to count that pro rata portion of an employee either engaging in qualified research, so they're performing the qualified activities. They're engaging in the experimentation. They're the ones trying to eliminate the design uncertainty related to that piece of equipment, related to that sample, related to that production process. They're the ones engaging. Now, direct support and direct supervision can qualify as well. Well, direct support could be somebody out on the shop floor that's maybe monitoring or running that piece of equipment for the first time that you just developed. Or maybe they're the ones creating the sample. They're directly supporting the research activities of the individual that may be designed or that's going to end up doing the experimentation associated with that. In the same vein, direct support can count too. The key here, folks, is direct. I have to be directly involved in the process. If I've got an employee that works for me and I'm their supervisor and they spend all of their time in research, I don't automatically get to count 100% of my wage. Rather, I get to count that time that's maybe spent directly working with them. Maybe that's design meetings up front or conceptual design. Maybe that's design review meetings. Maybe I'm the one testing it, giving feedback to that person, and then they're going off and doing some more experimentation associated with it. So they have to be directly involved in those research activities. Second category of expenditures is supplies used in the conduct of research. That's essentially any supplies or materials that are used in the conduct of research. Now, I don't get to count capital expenditures. Now, if I go buy a piece of equipment, and I'm sure there's some startup costs associated with it and so forth, generally speaking, you're not going to get to include the piece of equipment. Now, if I'm designing and developing my own equipment because I've got some performance specifications that require me to develop it because I can't find it out in the marketplace, well, now we have some supplies and materials that go into that pilot model or prototype that can qualify for that. And I'm going to dive into that a little bit more detail here in a subsequent slide. But those supplies used in the conduct of research are really any materials that go into that. Jeff, to your point earlier, you mentioned the samples. Certainly the cost of the samples, the materials that go into that, and the supplies and ink and foil and dyes and so forth that go into creating that sample can qualify for the credit as a supply used in the conduct of research. And then finally, the third category of expenditures is called contract research. It's where you pay a third party to perform research on your behalf. So let's dive into a little bit more detail here with respect to each of these expenditures. Qualified wages for qualified services. As I mentioned, you're engaging, supporting, or supervising qualified research. That is the definition of qualified services. Now, that first bullet point there says Treasury regulation guidance. The Treasury regulations say that in the absence of another methodology or another reasonable methodology, you essentially accumulate your qualified hours and you divide them by the total hours an individual worked, and that's the percentage of Box 1 Form W-2 that you get as a qualified research expenditure. Now, a lot of our clients don't keep time records like us accountants do, or an attorney might. And so if you don't have time records, that doesn't mean that you don't qualify for the credit. I'm sure you have other records, other things that could help you estimate and allocate the time out between qualified and non-qualified activities. This being an activity-based credit, we like to use activity-based costing a lot. So we'll actually outline your development process and ask employees to estimate the amount of time they spent on a particular process or a particular activity or task. That way your employees aren't necessarily trying to interpret the Internal Revenue Code. Rather, they're saying, well, yeah, I spend 10% of my time, running samples for prototypes. So, of the 2,000 hours I worked, I estimate 200 hours is associated with that activity. And then, somebody like me usually then gets involved in trying to explain that this is why this activity qualifies for the tax credit. And so that activity-based allocation helps kind of prove where the research is and how much of it is and how to different activities that could qualify. You can also use project-based allocations. Now, the IRS prefers this, so in the event that they determine that, hey, I've got a project here that I don't think qualifies, they can make an adjustment. And so the means and methods that you use to capture this really a lot of times relies upon some estimates. You've got a W-2 in most instances. You've got records that support what an individual might have been working on. Those estimates then kind of hone in and help allocate where that expenditure is between research activities and then just ordinary and necessary business expenses that maybe don't meet the definition of research. Now let's talk about that second category of expenditures, materials used in the conduct of research. So like I said, essentially any materials that are used in the research process. So earlier I mentioned new tooling or die development. And you might say, well, Mike, I capitalize my die development. Well, if you're designing the die or you're working with a third-party rule company to design a die, perhaps, you then bring that in-house and maybe use that in experimentation or test it and in my experiment to determine whether or not that die is the appropriate design. Well, that's a research expenditure, and it's exempt from the requirement to capitalize it. As a result, I can expense that. So in the event that I am incurring that as an expenditure, I can include it in my research credit claim. As Jeff mentioned earlier, the cost of samples can qualify here in the creation of that. And then, of course, internally developed custom equipment. We've talked about that a few times here on this presentation about where I have the need to meet a particular performance or functionality spec. I can't find that spec, so I go and I develop it myself. Well, that all of the expenditures that are incurred up until I've eliminated the design uncertainty and it meets my basic functional and economic need, meaning it meets spec from a performance specifications, and an economic need, meaning I can place it in service, I can start to utilize that piece of equipment, then all of that time that's spent in the design and the development and engineering and testing and more engineering and more testing all can qualify here. And those materials, not just the labor that goes into that, can qualify. Now, is the whole project going to qualify? Well, we don't know. A lot of times we dig in because there's something called the shrink back rule. And let's say I've got a feeder system that really isn't the focus of the research. The research was really maybe downstream in the process. Well, we might not use the feeder system. We may not include that as a material because it really wasn't the focus or used in the experimentation. It wasn't the focus of the performance or functionality that I'm trying to achieve. Well, that shrink back kind of requires that I look back and say, these expenditures qualify and were used in the conduct of research. These were not. And analyzing that and differentiating between the two is really important to be able to the ability to include these types of expenditures in my research credit claim. Now, one final category of expenditures, and that's contract research. That's where you pay a third party to perform research on your behalf. It could be an independent contractor, 1099 folks are certainly third parties. And so if they're doing research or supporting research, I get to count 65% of contract research. So a lot of times we'll comb your general ledger for outside services or outside testing, or maybe there's a process that you don't have in-house and have to have that sent out and then brought back in, and then you continue your process of creation of that sample. That can certainly, those expenditures can qualify for the credit. Now, this third bullet point I want to talk about here, the exclusion for funded research. Now, if I go to a third party and I pay them a lump sum, let's say $10,000 to develop something for me, I'm probably not going to be able to include that because they're at economic risk for that. I'm going to give them $10,000 for a result. Let me contrast that with an example. Let's say I'm going to go to the third party and say, look, I'm going to pay you $2,500 to try this. I'm going to pay you regardless of whether you succeed or fail. Or let's say, let me change the example a little bit. I'm going to pay $150 an hour to try this. If I'm going to pay them regardless of success or failure, I'm at economic risk. And therefore, I then get to include that maybe as contract research as long as I own the rights to those research results. I don't have to pay a royalty or a fee to that third party to use that information. Now, if it's a testing facility or maybe a subcontractor or vendor, you're probably not going to have those terms where you have to pay a royalty or anything like that. But I wanted to point it out because if you're maybe hiring somebody to help do some development work, you want to make sure that you own the rights to those research expenditures.
Okay. Michael, has there been any new legislation or guidance that impact FSCA members' research credit claims?
There has. There's been, I'd say over the last 3 or 4 years, there's been a lot of developments. Now, this first one I'm going to talk about was almost 5 years ago, and that was the Protecting Americans from Tax Act of 2015. A couple of things. As I mentioned earlier, the credit had expired like 15 times. This was one of those tax provisions that Congress continually had to go back and renew. It was part of the tax extender legislation many times. and they would almost always let it expire and then retroactively put it back into place. But they made the credit permanent in 2015. And so that really kind of gave some certainty to those that were maybe now believe it's worthwhile to invest in some systems to maybe capture some things contemporaneously throughout the year, and really just give some certainty to businesses so that they can plan and account for some of these investments they're making in development work. It also made some changes with respect to how I can utilize the credit. Now, before I dive into this second bullet point too far, I need to explain that generating the research credit, I've got to have taxable income or tax associated with the entity that's generating the credit in order to utilize it. The credit's not refundable. So let's say I haven't made money in the last 5 years, and I generate a credit. Well, the credit can be, if I don't use it, I can carry it back 1 year, one tax year, or I can carry it forward for 20 years. So unused credit can be of value, and I should still look to maybe generate that, but I still have to have taxable income in order to utilize the credit. The tax that I offset has to be associated with that. Now, if I'm a flow-through entity, I'm sure a lot of the FSEA members are S corporations or partnerships. I get to include the income that's attributable to the entity. So income that flows out to me individually, and then also any wages that I have. That's, of course, income that's attributable to the entity. So that's one limitation. The other is the alternative minimum tax. And for those business owners on the webinar today that have been hit by the AMT, it can be a surprise. Well, the research credit, if you're under $50 million in sales, average annual gross receipts from the prior 3 years, $50 million, if I'm under that threshold, I can now utilize the credit to offset not only regular tax, but AMT as well. And so that was a nice change to the credit to allow companies with less than $50 million of sales to utilize these credits and monetize them much quicker. And then for startup companies, they made a provision that says, you know what, we're not going to quite make this refundable, but hey, if you don't have taxable income and you're less than 5 years old, you're less than $5 million of sales, we're gonna treat you as a startup company, and we're gonna let you offset the employer FICA, your payroll taxes associated with that. So these three really impactful changes from this law that was enacted in 2015 to really, they're all taxpayer favorable, making the credit permanent and really the ability to monetize these credits faster. I talked earlier about the development of the prototype and the pilot model rules. They changed these rules and they clarified that they said it's irrelevant whether the results of your research are sold to a customer or used in your business. And so that really opened up the door for companies to claim the credit on things that they ended up either selling to their customer or was really kind of specific. In addition, there were some examples. I think it's the sixth example in these Treasury regulations that were issued. They said, developing new equipment or machinery, if it, in conjunction with the development of a new production process, those expenditures, the engineering, materials, and testing, all can qualify for this. And the key is, when did I eliminate the design uncertainty? When did I meet my basic functional and economic need? I get to include those expenditures prior to that. So these pilot model regulations that came out really kind of drilled down and clarified that some of these expenditures do in fact meet the definition and can qualify for the tax credit. One other final thing I wanted to talk about is when tax reform happened, they didn't claim the research credit or change the research credit, excuse me. They did not modify Code Section 41. However, they reduced the top corporate rate, the C corporation rate. Well, you might say, Mike, I'm an S corporation. That's not important. Well, it is for purposes of the value of this tax credit. Let me give you a couple of examples here. And I should say that, from a dollar amount or a quantification perspective, your credit is usually going to be somewhere between 4 and 10% of whatever your qualified research expenditures are. And I know that's a pretty broad range, but it is a credit for increasing research activities, and I have to increase over a base amount. So one of the ways that I calculate this tax credit is I look at the prior 3 years. And before I dive into this pre-tax reform and post-tax reform example, let me just walk you through an example of a FSEA member perhaps claiming a research credit. And let's say this FSEA member does not increase their research expenditures. They spend $1 million on research every year. I'm going to use that amount because we can all do the math in our heads here as we walk through this example. Let's say that I spend $1 million in tax years 16, 17, and 18, and therefore my base amount, the amount that I have to exceed before I get to my first dollar of credit, is equal to 50% of the average of those years. Well, that's $500,000, right? 50% of the average of $1 million each year is $500,000. Let's say that I like I mentioned in earlier, I'm not going to increase my expenditures. I spent $1 million again in 2019. I subtract off my base amount of $500,000. I have $1 million of research or $500,000 of excess expenditures. You multiply that times a credit rate of 14%, and I just got a $70,000 tax credit on my $1 million of research expenditures. And I didn't increase at all. Let's assume, for example, I spent $1.5 million in 2019. Well, now I've got $1 million of excess expenditures on my $1.5 million, right? So that $1 million times a credit rate of 14%, and I have a $140,000 tax credit on my $1.5 million. So as you can see, it really depends on what did I spend on my prior 3 years and versus what did I spend in the current year. But know this, I can have the same amount of research expenditures each and every year, and I can still qualify for a tax credit. So let's dive into this example here and with respect to what changed in tax reform. So before tax reform, the top C corporation rate was 35%. And so the way that you claim the credit and the benefit of this credit is I have $1 million of expenditures. Let's say my gross credit is $100,000. Now, the law says that I have to reduce my expenditures by the amount of the credit. So instead of deducting $1 million, I now only deduct $900,000. So I have $100,000 of additional taxable income. Let's say my tax rate's 35%, just to make the math easy. I got $35,000 of tax. I net to $65,000. Or if this is done on an originally filed return, I can make an election. That's what that Code Section 280C election is. Well, the Code Section 280C election is they say, well, you take the inverse of the top C corporation rate, regardless of what type of entity you are. And so if I'm doing this on an originally filed return, I make that election. So before tax reform 17 and earlier, my benefit, my real tax savings on my $1 million of expenditures was $65,000. But in 2018 and thereafter, the top C corporation rate is 21%. So that 79% is the impact of my 280C election. So I got a $79,000 tax credit. Folks, Section 41 didn't change at all, and the tax credit increased basically 22% of value here. If this is being done on an originally filed return here, as you can see in this example. So this is dollar for dollar savings. When I say net credit, that's your savings, assuming you have taxable income to offset or tax to go get that's associated with this. So, at a high level, this can be extremely powerful means of reducing your tax liability on activities that you're doing day to day to serve your customers. So, with that, I'm going to turn it back to you, Jeff.
Thank you, Michael. I think that our FSEA members and others in our industry can really take advantage of this. And as I said earlier, we have now established a relationship with Michael and Mueller Prost, Michael and his team can definitely talk to you and look at your facility and your company and potentially help you with this. So if you do have questions, please feel free to get hold of Michael direct. His information is here on the screen now. Or you can certainly contact me here at FSCA with some questions, and I can, get you and Michael together. So again, thank you, Michael, for your time, and we appreciate it.
Thank you, Jeff, and thank you to the membership. Appreciate the opportunity to present this to you all.